Congress lost their nerve, continued to spend like drunken sailors, while at the same time lowering the interest rate. When that happened, inflation went from the 7% range, as measured then, which is different than now,
Yep.
to the 12 or 13% range. And what that meant was that savings accounts were paying substantially less than the rate of the deterioration of the purchasing power of the dollar. And the gold price went parabolic.
Rick Rule's analysis suggests that the current economic environment resembles the challenges faced in the 1970s, marked by overconfidence, unsustainable fiscal policies, and potential shifts in the market. He draws attention to the role of gold in responding to economic uncertainties, referencing the historical rise in gold prices during the 1970s. While he doesn't explicitly provide a specific gold price prediction in this excerpt, his overall tone implies a belief in the potential for a significant increase in gold prices. In the context of the present, Rick Rule seems to be cautioning that the confidence built over the past 40 years might not align with the economic reality seen by credit analysts. He anticipates a divergence between what a hardworking credit analyst might discern as potential challenges and the perception of investors, speculators, savers, or taxpayers who may be lulled into a false sense of security. This suggests that, in line with the historical parallels, there could be a disconnect between market sentiment and underlying economic fundamentals, potentially leading to a surge in gold prices as a hedge against economic uncertainties. With that, let's dive into his thesis.
I think somebody said history doesn't repeat, but it rhymes.
Mm-hmm.
And I think that's accurate. There's a lot of things that have changed. But if I had to pick a time that this feels more like, perhaps it would be the 1970s, at least in the United States.
Mm-hmm.
Like the 1970s, particularly because in the 1970s, we had come off of 20 pretty benign years. Since the end of World War II, the United States had led the world in a fairly peaceful time from 1945, certainly through 1965.
Right.
Great credit markets, great equity markets, demographic expansion, peace, the expectation that things were only going to get better. While under the covers, things were getting worse because we had the confidence and because we tried to focus on more important things, we allowed for the inexorable rise of government. We developed this counterparty in our life that turned out to be a cancerous counterparty. In the United States in particular, our confidence led us to attempt to fight the war in Vietnam and the war on poverty simultaneously. By the way, we lost both wars.
Yeah,
and
indeed.
Trying to finance both guns and butter, we ran into a circumstance where we violated a wonderful old ditty. The ditty goes like this: when your outgo exceeds your income, your upkeep becomes your downfall. It was very clear to anybody who paid attention, which is to say any credit analyst, that by 1970, the fiscal course of the United States and the Western world was unsustainable. But because we'd been through 20 or 25 good years, people ignored the warning signs. They had been taught to buy the dips. They had been taught that interest rates only go lower. They had been taught that equity and real estate prices only go higher. So despite the fact that the financial condition of the United States in particular was deteriorating fairly rapidly, confidence reigned. Now, they did deregulate the gold price. So the gold price went up fairly precipitously, not merely because of the fear of inflation, but rather because it had been price controlled for 40 years. In the middle part of that decade, I am convinced myself that the inflation lesson hadn't been learned yet. But in the middle part of that decade, the Federal Reserve, acting wisely, I believe, raised the interest rate, which collapsed the gold price.
Right.
Gold had risen from $35 an ounce to $200 an ounce. Raising the interest rate took the gold price down by half. But it also took the stock market down, and it decimated the bond market. Congress lost their nerve, continued to spend like drunken sailors while at the same time lowering the interest rate. When that happened, inflation went from the 7% range, as measured then, which is different than now,
Yep.
to the 12 or 13% range. And what that meant was that savings accounts were paying substantially less than the rate of the deterioration of the purchasing power of the dollar. And the gold price went parabolic while the equity markets and the debt markets collapsed. In that sense, it seems to me that the decade that we're coming into resembles somewhat the decade of the 1970s. We have now come off 40 fairly benign years in the 1982 to 2022 period. I'm not trying to say there weren't some challenges, 2008, stuff like that. Mm-hmm. But we've come through a period of 40 years of declining interest rate, strong US dollar, and the strong US dollar moderated at least the impact of inflation. I think that's over.
Right.
But I don't think that the confidence has subsided, which means that I think that there's going to be a 2 or 3 year hiatus period between the reality that a hardworking credit analyst might see as an example and the reality perceived by an investor, speculator, saver, or taxpayer who has been lulled into security by 40 benign economic years.
In this next segment, Rick Rule expresses optimism about the future, envisioning a much improved world 15 years from now. However, he underscores the need to navigate the journey from the present to that envisioned future. Rick emphasizes that this positive transformation won't be orchestrated by governmental bodies, but rather driven by the inherent innovation and creativity of individuals. Using examples like Google and Apple emerging from garage startups, he highlights the extraordinary capacity of society to overcome challenges through ingenuity. Rick Rule concludes by asserting that the key challenge in the coming decade will be for individuals to take responsibility for their well-being.
I think the world 15 years from now is going to be much better, almost unimaginably better than it is today. But I think we have to get from here to there. And I think we need to understand the nature of the improvement. The improvement is not going to come out of Washington or Ottawa or Brussels. The improvement is going to come because, at least in the United States, we are still such an innovative society. We are still so tolerant of success, at least for a while, that 5 or 6 young kids can commandeer a garage in Sunnyvale, California, and out pops Google or out pops Apple, which is to say that our individual creativity and tenacity is so spectacular that we have been able to and will continue to be able to afford our collective stupidity. But that assumes that each individual looks after his or her well-being. And I think that'll be the challenge for the next 10 years.
Let's recap today's insightful discussion with Rick Rule. We delved into the historical parallels between our current economic landscape and the challenging 1970s. Rick highlighted the potential risks stemming from overconfidence, fiscal unsustainability, and the changing dynamics of the financial markets. As we navigate this period of uncertainty, Rick encourages us to be vigilant and learn from history. Looking ahead, Rick Rule paints a picture of a brighter future, envisioning a world that is unimaginably better in 15 years. He emphasizes the role of individual innovation and creativity in driving positive change, citing examples like Google and Apple that emerged from humble beginnings. As we embark on this journey, Rick leaves us with a crucial challenge for the next decade: the responsibility for each individual to look after their own well-being. The path to a better future, according to Rick, lies not in government intervention, but in our collective ability to innovate and adapt. Thank you for joining us today. If you found this discussion valuable, don't forget to subscribe, like, and share your opinions in the comments below.